Yesterday saw U.S. inflation data once again coming in hotter than expected. Companies are facing pressure to deliver on Wall Street's lofty earnings expectations. We are joined now by Dan Rohinton, Portfolio Manager with IA Global Asset Management. It's great to see you, Dan. Thanks for coming on the show. So, Reuters actually says that investors are trying to stomach the prospect of no U.S. interest rate cuts this year. I mean, that's quite a turnaround, isn't it?
We started with expectations of almost 7 rate cuts.
Wow.
And we're now around 2. And you might have a ceremonial cut here and there, but the idea of a material rate cut cycle, it's coming off the table now.
The Fed just doesn't want to go there with the economy still strong or pretty strong and inflation still hot.
And it's driven by services, which tends to be the stickiest component of inflation as well. So the whole fill in, the push through labor, and that's before talking about energy prices and commodity prices that are now up year over year, which are going to feed its way into inflation through indirect means.
It's interesting that the Wall Street Journal has a good story today about, forget mortgages, but the actual underlying cost of home ownership has soared, maintenance, and in particular, insurance, home insurance.
That's partially for many different reasons, and same with auto prices as well. So car insurance prices have also been going up at a similar rate. You can say climate change, the tightening up of reinsurance markets and primary markets. But in general, the cost of living continues to march higher in some of the areas that aren't as directly measured in the Fed's preferred inflation gauges like Supercore.
Technology, communications, you're actually warming up to those sectors a bit.
We have. And what we've seen is, especially when you're thinking communications, you're really only talking Facebook and Meta. The rest of the telecommunications space, such as Verizon, AT&T, are far smaller. So the big two in tech are Facebook and Google. And especially Google, we've seen a change in how they're approaching their go-to-market. They're getting more nimble now than they used to be. So the initial, black eyes they got with their AI rollout on the generative side, it's actually gotten materially better. So you can see them really step up, and that's dragging communications higher to the positive.
And over at Meta, Zuckerberg seems to have backed away from that virtual reality world he wanted to plunge us into.
He's still spending tens and tens of billions of dollars at it.
Oh, okay.
It's no longer an incremental headwind. It remains a headwind for investors because really there's a lot of scar tissue that came with what Apple did in going into the advertising market and pushing Facebook further down in their ability to target. So that's why this multi-billion-dollar earnings loss is going to stay with us, because it's all about betting on the next platform transition, which is some form of mixed reality or virtual reality. So that headwind is not going to be any worse, which ironically is, funny enough, good for Meta.
But so Alphabet and Meta, for example, offering decent prospects right now.
Yeah.
What about real estate? Is there any opportunities? Are there any opportunities there?
There's always opportunity depending on the companies that you're looking at. But take a step back and ask yourself, as interest rates are going higher through what we're currently observing as a bear steepener, as those rate cuts are getting priced in out of the back end of the curve, there's just better places to find interest rate sensitive defensives. So you don't need to capture the double headwind of real interest rates along with occupancy issues that you have in real estate. You can go to regulated utilities for pure defensive exposure. And if you want a little bit of commodity exposure along with defensive interest rate exposure, then maybe midstream is the place to be. So we think real estate just falls down when there's just two better versions of the same type of defense out there.
When you say midstream, energy, gas processors like a Keyera or somebody like that, or a pipeline company?
A little bit more regulated, like Enbridge or TransCanada, or in the U.S., some of the U.S. midstream companies like Kinder Morgan.
Right, as a play on what? Interest rates?
Interest rates and continued strong, robust production across the main North American basins.
Right. There's Enbridge, for example. Enbridge, of course, still down about 12%. I know it's gone up from its lows of the fall. And the yield pretty high on those pipeline stocks still.
Yep.
Talk to us about this forthcoming earnings season. In the absence of interest rate cuts, or many interest rate cuts, will the focus be on profits? Absolutely.
And they better deliver, because expectations with what we've seen since the October-November lows in the market and the almost 30% plus rally we've seen, the onus is now on corporates to deliver on those returns, because expectations for the S&P 500 for this year are around 12% year-over-year growth. That's a tall order to consistently hit. And you can get it through companies like NVIDIA and some of the big tech stocks, but the other S&P 495 also need to come through as well. So this earnings season is important for what we deliver and also the outlook for the rest of the year.